Hello, this is Guy Grant, your Spring Hill, Florida realtor, coming to you today with some information about interest rates. You may have heard that the Fed increased their benchmark rates again, but only 1/4% this time, which is good news. They had been going up 3/4% or 0.5% each time. This time they only raised it 1/4%, and that had very little effect on interest rates for mortgages. It was 6.09, it went to 6.12. So they raised it 25 basis points and it only went up 3. So that's actually really good news. Um, and yeah, their benchmark went from 4.5 to 4.75. And you might be asking, since the big rise in mortgage rates has had an effect on the real estate market. I mean, sales are down, they're saying 17.8% year over year. That's not prices, that's the number of sales is down almost 20%. So you would think, maybe they've done what they want to do. But I really think it has a lot more to do with the jobs report. The jobs report came in unbelievably good. They created way more jobs than what they thought. The unemployment rate has dipped to 3.4, which if you look at the table, this was pre-pandemic. We were at 3.5, so we're right down to 3.4. So, I mean, we're basically pandemic unemployment is over. You can see the huge spike went up to almost 15%, but the unemployment has dropped way down, and historically it's very low. It's at real low levels. And what they want to do is actually um, have some people get laid off because there's too many jobs available right now. There's more jobs than there is workers. So if you read what they're trying to do, the Fed is aiming for a soft landing. They hope that employers can slow wage increases and inflation by reducing job openings, but not necessarily laying people off. So you'll be stuck in the job that you don't like, and you'll only be getting your 4.4% raise when inflation is running at 9.1 or 6.5 in December. It came down. So you're going to be losing purchasing power, but they don't want you to be able to find a better job. They don't want to admit that this is actually the problem. The government spending way more money than they have, but we're stuck with what we're stuck with. But so far as where the unemployment rate is at, as long as it stays down real low, I don't see prices of houses coming way down, because this was the recession and the bubble in 2008, and unemployment was up 9.9, almost 10%. That unemployment rate is 3 times where we're at now. So yes, there has been a correction in sale prices, and there's definitely been a correction in the number of sales that are going on. But so far as seeing the bottom fall out, that's just probably not going to happen. The other thing everybody should just be aware of is that even at 6%, we had a little over a decade here below 5, but going back historically for the whatever that is, 35 years before that, interest rates were not below 5%. So if you're waiting for it to get back below 5%, you could be waiting another 35 years for that to happen. There were some really good times in here when it's between 5 and 7.5, and that's where we're at. So I'm kind of hoping things normalize, stabilize, and we're able to just sell a reasonable number of houses at a reasonable price. There was actually, looking on the hot list this morning, there was 2 nice 3-bedroom pool homes in Spring Hill for under 350, which is good. So and like I said, historically, a 6.1% interest rate is good. So I believe it's still a good time to buy. I think the economy is actually in pretty good shape. So if there's anything I can do for you, get a hold of me. Until next time, thanks.